Good afternoon. My name is John Miller, and our program today is Cash Management, Meeting Budgetary and Market Challenges.
And my name is Robert Lowery, and I'll be assisting John Miller today.
This afternoon we're going to provide you with a number of definitions, background on our topic, cost projections, cost management techniques, and then put it all together.
So the definition for cash management is a continuation, a process of planning, budgeting, finance, funding, managing, and controlling your costs throughout the project so that you have a successful project.
You know, Robert, we always like to pull together these presentations with some statistical data and some background on why this topic is really so important. You know, statistically speaking, only about 10% of construction firms survive every year. Over 80% of those failures are tied to the failure to predict budgetary issues that affect the bottom line, as well as macroeconomic issues. That's a fancy way of saying a fluctuating economy. Timely and accurate management reporting is a key element to all of this, and I'd like to also add that only about 30% of construction projects come within 10% of their originally projected budget. We're going to link two levels of reporting, financial management reporting, cash management reporting, this afternoon. One is the executive level or management level, which I'll talk about. Robert's going to talk about project level reporting, and then we're going to pull that all together in our concluding slides. From an executive level of financial reporting, there are basically three constituencies served. Of course, management directly, but also your external partners, your surety broker, your surety agent, and your lender. And of course, you can't manage the behavior of employees in the field without good field level job cost reporting. Key reports to develop and manage by. Let's start with the real fundamentals. There are a myriad of other reports that are either developed typically in the marketplace or by individual firms based upon their own individual needs. But the financial statement, the balance sheet, and the profit and loss report is key to financial reporting. Your schedule of work in process, which ties into the balance sheet and the profit and loss statement. A cash flow projection that is regularly updated and again tied back to financial results overall. The buyout process, job status report and general conditions projections, pay applications and change order logs. All of those will be covered by my colleague Robert today. Now I'm going to skip over the financial statement, the typical balance sheet and profit and loss report, because that is a snapshot in time. It's a rearward looking report on your immediate financial results. What I'd like to focus on is how we keep that report fresh in terms of current information. And that's through our work in process schedule. The work in process schedule is a yardstick on your immediate results as respects your cash management and also your bottom line. There are 5 basic elements of a work in process report. That would be the contract price on each project, your estimated costs, your cost to date, your billings to date, and your cost to complete. From those 5 basic elements, all other calculations of percentage of completion, earned income, billings in excess of costs, costs in excess of billings, all are calculated from those 5 basic elements of the work in process spreadsheet. You're able to identify with your work in process, as I mentioned earlier, your percentage of completion on each project and on your overall work program or backlog of work, percentage of completion on it overall, your income or loss on a per project basis and on an overall basis, your true balance sheet position based upon over and under billings, the latter carried as a current liability, the former carried as a current asset, and your actual profit or loss to date. The cash flow projection is a report that you would run more frequently than your work in process. Your work in process would typically be run every 30 days. Your cash flow projection is something that can be run week by week. And the basic elements to a cash flow projection are really very simple. It's your beginning cash position for the period. It's your cash in terms of progress billings or accounts receivable. Your cash out in terms of direct and indirect or variable job costs. Your ending cash position. So inflow less outflow equals net cash flow. And from this report, you're able to properly manage the demands on your cash, again, from a week-to-week basis to a month-to-month basis, potential shortfalls in the availability of cash, and how to manage your cash flow.
So John, let's show them an example of how this works.
Sounds good, thank you. All right, looking at the screen here, in the upper left-hand quadrant, we've got a company we call Jack Frost Construction. The upper left-hand quadrant is nothing more than a recitation or a breakdown of the job at hand. You can see this job has a $430,000 contract price. The direct costs subtotal is $364,000, and our gross profit is $66,157. Those numbers in that upper left-hand quadrant carry over to the right-hand side of the cash flow projection in column AI there. Again, 430 down through the 364 in direct costs, down to our actually this happens to be our net profit figure of 33,000 on a gross profit of $66,000. Now, going back to the second quadrant here in the cash flow projection, you're now going to map what your beginning cash position is, and we start the project with a working capital position in our construction company of $70,000. Now, if we identify, as we break down and identify the costs that tie back to the direct costs in the left-hand side there, you'll see that our labor budget is listed down below as direct costs, and our material budget is also listed. And this happens to be a project that has a very heavy, long lead item material purchase up front. So when we look at our cash position of $70,000 and the two material purchases that need to be made in the first week of construction, you can see that the sum of those two numbers outstrips our available cash. Luckily, we have a working capital line of credit of $200,000, so we take down $100,000 of our working capital line, and we begin the project with $170,000 of available working capital. That gives us an ending cash position at the end of the first week of $69,000. That's our beginning cash less our cash out for the materials, and equals our ending cash. That ending cash at week 1 becomes our beginning cash for week 2. And then expenses associated, as you can see in the early going there, those materials are ordered. There's really no labor expense on the front end, so our ending cash position really carries over to week 4, which is $69,754. In week 8, we begin to experience labor cost impact. So our ending cash in week 8 is down below there, Robert, thank you, is $43,000. That becomes our beginning cash position in week 9. And our first progress payment comes in, $110,000 there in week 9. So our cash position in week 9 allows us to take down $50,000 of the money we borrowed on our revolving line of credit. And we start the week with a beginning cash position. I want to say that's $123,929. So you can see how in a cash flow projection, again, we're taking beginning cash, we're looking at cash out, then cash in the form of progress billings, okay, and our ending cash position. When we get all the way over to the right-hand side, after week of this project having evolved and all of our progress payments coming in, you can see our ending cash balance is now the sum of our profit, of our net profit of $33,000 on the project, and our beginning cash, which was $70,000 or $103,000. So $70,000 and $33,000 comes to $103,000. That essentially gets contributed to our financial statement on our next financial report.
So I have a question, John. So once you do one of these, what is this used for?
Well, you would want to update this cash flow projection based upon job cost reports that are developed actually on a daily basis and then perhaps consolidated on a weekly basis to update this job cost or cash flow projection. You would also, as we get into later in the discussion, you're able to track the impact of change orders and delays and other issues that affect cash flow on the project. Those are the budgetary things that we talked about earlier that are so important to identify so that you can take immediate action in order to mitigate their impact as the project progresses.
So, well, another question for you is, so if we have multiple jobs, we have these going, I want to go out and get a line of credit, could I use these to apply for a line of credit?
Yeah, and you can consolidate this report. There are ways to do that in a general sense. Obviously, jobs have different start and end dates, but you can look at your backlog, okay, and your work program being the total of all projects out there, okay, and your cost to complete backlog. You can work that into a consolidated report on depicting the cash flow of your company going forward.
Okay, great. All right, thank you, John. Okay, we're going to move over now to the cost and cash management of this presentation. So basically with cost and change management, you know, your scope has a big part to do with your costs and your scope. You know, understanding what your scope is for the project so that you don't have any scope gaps, which, you know, also affects your costs. And you also have your schedule values, so once you have bid out the job, you have talked to the owners, and you know what your schedules and values are, because that's the key thing that needs to be used in order to do your payouts. So understand your schedule values and your scopes are the two most important things right off the bat as you're starting to kick off a job. The schedule is important because that is tied into all your activities that needs to go with that, and also your duration, because with the duration you can then develop your general conditions, which will show you an example of that later on. And the buyout process and your fee enhancement. Fee enhancement is your profit. So say on lump sum jobs you have sub-tiers under you and they give you a price and you submit that price to the owner and you award the jobs. You want to go back in what's called a buyout process and come back with the best and final number from them. That way you can have a cushion in case you have scope gaps, or if you have savings at the end is your fee enhancement. So a buyout process is critical to the successful of a project. General conditions and general requirements, knowing exactly what you're spending on each person, if you have trailer rentals, etc., general requirements. So I will show you some examples of that, because that is managing the cost of the project, because you want to make sure you don't overrun with your general conditions and general requirements. And with that, I'm going to show you an example of a general conditions, general requirements. So if you look up here, you know, it's an internal document that can be used just for yourself and no one else. So as you can see, you know, the construction, you know, pre-construction, say, you know, it could be 2 weeks. And you see how it kind of changes. Your construction time is in weeks, and then closeout. A lot of the times people forget closeout because that's a cost. You've got people doing your closeouts, so you have to make sure that you put that in there. And then as you can see, you know, you can put your square footage in there, and you can also come out with your cost per square foot, which is creating historical data for you. So that is critical that you kind of use it. This is a worksheet. Moving down, so once you determine, you know, your weeks, your durations, you want to then go into your project manager if you have a project exec, or if not, you put a 0. If you have a project manager, determine their percentage that they're going to be on the job. Then once you do that, say for instance you're going to have a project manager for pre-con 75% of the time, which comes out to 1.5 weeks. So with that 1.5 weeks, as you can see, you have your price over here. Now keep in mind, with this price, it's your fully burdened cost. Your fully burdened cost is what you're charging the owner, you know, with all your markups, everything that's associated, benefits, everything. That is what this is. And to come up with this $5,600, for example, it is whatever your hourly rate is times 40 hours. So this UP here is weekly. So as you can see, as we've got 75%, so a week and a half for project manager doing pre-construction, comes up to $5,400. And you can see it does add up here, so it helps with your running total. Another section that you want to be aware of, as you can see on the screen, is your project administration. That's the key. Your accountant is going to be in there. If you've got a project engineer, anything that you need to do is here. And the way this is set up, you can just put in your percentage. A lot of times the accountant only does about 10% of the job, which is about 2.6 weeks, because they have to do weekly payroll. But, like I say, you just put all this in and the sheet populates for you. Supervision, it could be your superintendent or your foreman, whoever's going to be out in the field. Because with safety, you want somebody out there 100% of the time. And that's why the superintendent is listed at 100% for 24 weeks. So remember, the construction phase is 24 weeks. So at $4,500 a month, a week, it comes out to $109,000 for your superintendent for this job, as the example here. So, if you got anything else, transportation, fuel, permits, try, if you got to put this in here, so be it, but try not to put permits in here or insurance. Also, if you've got office and engineering expenses will go in here. So it's a great tool that you can use to come up with your general conditions, general requirements. So as you input all this, trailer utilities, construction, if you gotta have temp power, so all that goes in here, and it's a great, when we scroll down to the bottom, and do not put insurance in your general conditions, you want to have that separate. So it comes out, so your GCs for this 26-week job is $297,000, I'm just rounding it up. So it comes out $53,000 a month. So this is how you kind of know who's getting what, how much it is, because this segues into another sheet later on. But you're going to do this general conditions, general requirements template when you're bidding the job. Like I was saying, the schedule is important because it helps you, as we go back to the top, it helps you write your schedule. Remember I was saying schedule is important and know exactly how much it is. So that is how you're going to develop your general conditions, general requirements for a job. And this also can be used, like I said, when you have to tie it back into your cash flow sheets as well, which John will talk about later.
Robert, let me ask a question. This obviously is a very comprehensive breakdown. And from time to time, we see within the general conditions the need for a hoist or a lift or other and operators for that type of equipment that would be retained within the general conditions and not necessarily subbed out in a traditional sense like the other divisions of work.
Correct.
Can this sheet be modified to enter the costs associated with all of that, or how does that work?
Yeah, you can. Like I said, with equipment, you can modify this sheet. You could put it under expenses, engineering expenses there. This sheet can be modified however you want, but as long as you know where you have it, it's going to help you out.
Yeah,
Because even with the operator, you can put the equipment in here, and the operator could go in another section, let's say, where it says craft and punch list.
Yeah.
You could put the hours for that person operator there.
Right.
So that way you have your equipment in one cost there, that's rental because you don't own it. And then you got somebody that's operating and you know how much you're going to be charging, paying that person.
Very good. Okay.
Great question. And so payroll is one of those cost things that you have to do. For public works, you have to report weekly. So it's critical because that's part of your costs, which then goes back into their general conditions. You've got your superintendent or anybody that's out in the field, you know what the rates are. And it's critical that on public works jobs that you go to the DIR, get your determination rates, because if you mess up on that and you report wrong, there's fees and penalties. So you want to make sure that you have the right rates. So that's all going to be given to you during the bidding phase. And another thing is the pay apps and the billings. If it's monthly, that you're doing, like I said, with the schedule of values, this is where it ties into your pay apps and billings. And I'm going to walk you through a typical pay app that I have used on previous jobs, and it's great because it has all the details in this one sheet, and when you generate it, it's going to be great. So as you can see, you know, your pay application, whatever is your number one, the date of it, the period through, is going to be input. So a lot where you see these yellow items is information that you're going to put in to help generate your pay app. And you know, these Excels, you know, you can also spend a lot of money to buy programs to do this, or Excel, if you're whiz at it, you can generate all this in Excel and tie these sheets together. So once that, and then you have a cover sheet, because a lot of times when you submit your billing to the owner, they want to see a summary right away instead of going into a lot of details right away, because they're going to like, okay, yeah, this lines up. As you see, it has your original contract amount that's listed there, and the sum to date, and now, you know, which is great because this is a high level report. So like I say, if I'm going to report to John, he's the exec, he might want to see just this one sheet to help fill in your reports. Now switching back to the documentation, the AIA 703, AIAG 703. As you can see, now my scheduled values have been put into here, and the quantities. So it's all listed right here, and it helps you as you go. And of course, this one here is already, it's like for pay period number 2, where it was the previous was in there. But as you can see, I'm going to go ahead for this period. I'm going to say, you know, I spent $2,000 here. And as you can see how it takes completed to date, your percentage, and also it keeps out your retention of 10%. So as you can see on this pay app, you go through, it shows you your retention. And on this contract, the retention is 10%, but on most public works, it's 5%. But keep in mind, if you're going to use this for commercial or private, it depends. You just have to go in to here and put in your percentages for your retention. And as you can see at the bottom how it lays everything out, then that ties back into G702, which is kind of like a cover sheet that goes to the architects for review and approval. And of course, this needs to be notarized, so it has everything on here. So this is a great detail of everything because it doesn't have a lump sum, because this will help you with submitting your pay apps to the owners or to the primes. And then the key thing I want to bring to your attention is with the pay apps, you want to sit down with the primes or the owner at the very beginning, ask for their format, when it's going to be due, so that way you're not holding up their process, because a lot of times it's due on the 5th of the month. So if you got tiers on the U, you want to say maybe it's due on the 2nd, so you have time enough to get all the information that you need to put together conditional, unconditional waivers that also needs to encompass this pay app and billing. So it looks like it's a lot of work, but setting it up, John, is the trick. But after you get it set up, it's a piece of cake.
Yeah, I can see we're having the 703 feed to the 702 would
Right.
greatly speed the process along and increase the accuracy. But
Right.
you mentioned the idea of billing on the 5th of the month, which has traditionally been pretty much the time frame, and you would want to get that process going on the 2nd or 3rd and make sure everything is aligned. But we read contracts today very often where the billing period is maybe between the 15th and the 25th of the month. Would you bill in advance to the end of the month, or is it always a retrospective billing in those cases? Because if you're billing on the 5th, obviously it's through the most recent 30th or 31st or 28th, whatever the month happens to be. But when you're billing prior to the close of a specific month, do you submit for what you expect to accumulate in the way of direct and indirect costs until the 30th.
Yes, you do. You're gonna project, where you're gonna be, which comes back to the schedule.
Yeah.
Because when you're updating that schedule daily, weekly, you know where you're gonna be with certain activities. And say, okay, I'm at 70% now, and it's the 5th of the month, he's on site, and so the glass and glaze is gonna be finished by the end of the month, so go ahead and project 100%.
Yeah.
So that way, because a lot of times the billing is more than 30 days, 45, 60, 90 days, and sometimes they will allow you to project through the end of the month, even though they want it at the beginning of the month. So, if you gotta correct it for the next month coming up, you can go back and adjust it.
Mm-hmm.
So it's always a give and take. It depends on what they want from you, the expectations.
Very good. Okay.
And, which leads back to a good point. It's also with materials, if you got materials that's on hand, but you haven't done the work, you can also now identify on this 703 materials presently. So you can put your costs in there, but there's documentation that you're gonna need to prove that it's in your warehouse, so you can bill for it. You got pictures, there's your bill labeling, everything else that they want to see that so they can pay you, when it comes in.
Yeah, even at that, it's usually only a percentage of delivered materials to the warehouse properly documented, as opposed to those that are actually on site in the field and installed. It's typically a contractually
Yeah.
percentage.
Right.
But what you're pointing out is how this whole discussion really ties together in terms of looking at estimate, schedule, and cash flow. All of these things tie together to produce an accurate financial picture as you're migrating through the project.
Yeah, it's showing, like you said, John, it's a picture.
Yeah.
You're telling a story.
Yeah.
And that's what, in case somebody gets hit by a bus, somebody has to pick this up and knows what's been going on.
Yeah.
And that's the key thing for small contractors. They want to skip steps. Do not skip any steps, because it's going to hurt you at the end. So that's one thing when I mentor contractors in the field, when I meet with them, is to do not skip any steps. It might look like a lot of work, but it pays off in the end. Yeah. And next topic is we're going to go into this change orders, which is the change management part of this whole discussion here. And this is critical here. Change orders has a lot to do with, you're going to have a great project manager that's in the field with this, because change orders needs to be done daily, so that way you have great documentation with that. So I'm going to go into change orders, and here is an example of what's in a contract. So the key thing is with change orders, anything that's in the terms and conditions of your contract or subcontract, read it. If you do not agree with it, redline it, have discussions with the owners or the prime. So therefore, you are having a profit for your company, and you're not suffering because there's like, here's a subcontract, sign it. You see that a lot. No, legally you have the right to review all these before you sign, negotiate, and then move. So like for instance here, your markup for change orders with this contract is 15%. That's all you get, so you can't mark up any more than that. And it also talks about how often when you need to submit it, how you need to submit it. It's like within 3 calendar days. So if you have a change order and they ask you to change something, you got 3 days according to this contract to get it in writing and to them. And if not, they're going to say, well, it's on you. So that's the key thing. A lot of people misunderstand change orders and the contractual agreement. Read it, make sure you understand what's going on. And it's just some more of the change orders. Just wanted to give you an example that you can read through and see, with everything that's in there. And a lot of times with a change order, you can submit it, and if it's a project that's on a fast, accelerated pace, sometimes they're going to say submit it. They're going to give you an informal proceed, but you always want to get something in writing, because you know what happens, John. If you don't get it in writing, it's going to be he said, she said,
right. And
then there's no supporting documents, which I will go into later how to put together a change order packet. And so, with the change order log, which is where I'm going next, there's different columns that's gonna go in there. PCI, here's some definition. PCI is a potential change or cost impact. So with that, that's critical. So you're out in the field, your superintendent comes to you and say, hey, we see something that's unforeseen, whatever. So you automatically gonna write it down, give it a ROM right away, and that's gonna be your potential change impact or cost. Because you wanna get these surprises to the prime and the owner right away, don't wait till the end. And like I said, there's different types of change orders, as you can see on the board here. There's three primaries: change to owner, which goes to the owner. No change to owner is or internal. Back charge is trade-related damage. And then there's different statuses that you want to track your change orders once change order requests. But right now, it's a request that you're submitting. So as you can see, there's multiple ones here. And these, as you see, the statuses here are more of the most common ones that's being used in the industry right now. And OCO, if you're dealing with larger general contractors, is an owner change order, like I mentioned earlier, that goes to the owner. And it's a package that you're gonna put together of different information that's gonna go in there. So a change order request can also be bundled with number of the PCIs. So it's almost a pyramid effect. So you have, let's say you've got 6 potential cost impacts. You want to put that into one change order request, then that's that. You have 3 more, you can bundle it, and then it goes into an owner change order request, which can have multiple change order requests in there. It just depends on how they want it presented. Sometimes they want it one for one, because that way it keeps their books a lot cleaner. And another column that you'll see on the change order log is your categories. It goes from schedule impact all the way down to accelerations. And then you want to make sure you document the owner or the prime directions from notified or waiting for directions or do not proceed. Because right away, when you have these weekly meetings, I suggest that you have weekly meetings on change orders with the owners and primes, because you want to reconcile at the end of the month, which will help your cash flow. Because you know what got rejected, you know what's being approved, what's still pending. Because the pending ones is a risk for you, and how are you gonna handle risk? You wanna minimize risk by getting change orders requests reconciled monthly. And now we're gonna go into change management tool, change order request log, like all those definitions I was going on in the previous slides. Now comes into effect here. And I'm gonna go into an example. And once again, this is all done in Excel, but there are other programs out there. CMIC is another one, but that's an Oracle-based program that can do this, but it's very costly. It's basically a spreadsheet is what we're doing here. So I talked about a PCI number. So as you can see, let's go with the first one here. PCI 3, and you give a description. It's an HVAC second floor schedule acceleration. Now they want to accelerate the project, John. So once again, you need to track the cost.
Cost impact, yes.
Yeah. So, and key thing is when you're doing these, that description has to be very detailed, because this is telling the story why this is happening. Of course, you can change your description after you get it going, but at least get something in there right away, so that way you know. And then with the type, there's a type. Okay, I'm gonna send this to the owner because he's accelerating the schedule. So that's the change the owner. And of course, with this one, this thing has been worked over many times. But the status, it can be approved, submitted, proceeding. That means you're moving on because you got a scheduled deadline to meet there. Then the date that you created this PCI, and then the date that you submit to the prime and the owner, and the amount. And then remember I was talking about with the OCO, the packages, how you can package it here. And like I say, this first one was a OCO number 1, change order number 1, which is the PCI. like on this example, it's 1-for-1. I don't think I have anywhere where I have multiple change orders in one OCO, but it can happen though. And the category, like I said, schedule, unforeseen conditions happens a lot. Design changes. Another one you'll see on that list that previously is errors and omissions. That errors and omissions most time is on your design team. And when that happens, the owner wants to know that because he can go back charge the design team for these errors and omissions. So it's great that you break it down and understand days impact, how many days does this change is causing your delay or whatever, the date it was approved, and the owner direction. Like for this first one is proceed. So at that point, you put it together, you know proceed, then you can put it onto your schedule of values and your billing at that point, once you get the owner says proceed.
Yeah, this is just so important, and the depth of documentation is really important because many times your contract is written in such a way that you, as you say, you have to proceed, you have to meet the schedule. And if you're going to proceed, you better have the documentation in place, you better have at least some sort of submittal going for and proceeding towards approval in order to protect yourself.
Right.
The fact that you get to an approved status at some point really doesn't have anything to do with the fact that you've got to proceed based upon an owner-driven directive, and the documentation has to be precise. I see what you're saying. This is a great format for that.
Yeah. And then with this format, I have filters. So if you just want to know your ones that's been proceed, I can just do that, and it just hides everything else.
Mm-hmm.
So once again, then you can take a snapshot, go to your executive, and say, hey, this is what I got approved for this month.
Yeah.
What's pending or not proceeded. So it's a great tool using filters when you're doing these logs, because you can filter, it saves you time. I mean, it's just instantly click a button and there it is. So it's the more that you put on these logs, the better off you are. Okay. And we've been talking about what's included in a change order request packet. And like I said, that is, you want to tell the story. Any submitting documents, there's a cost. If you got tiers under you, suppliers, you want to get their costs, put that in there with that 15% markup like this example had. You want to show that because the owner wants to make sure you're not just giving a bogus number. Because a lot of times they have a cost manager that's going to sit here and go through every one of these change orders to make sure that they're valid. I've had examples where I submitted a change order request, cost manager comes back and say, hey, no, this is too many hours. And then we have to negotiate. But when you have it all broken down, it makes it easy to negotiate. Like I said, if there's any drawings that was issued by the architect, you want those drawings in there. Any emails, like I said, if you're accelerating because you have to meet a schedule, take that email, put it in there. That shows that you've given the formal field directive to proceed. That's the key word. And when you're writing up these packets, make sure you use some great words to also direct whoever it is that's reviewing it to approve, because it's like, hey, your guys told me to do this. So that's what's got to go in these packets. I mean, it could be 20, 30 pages. If there's an RFI that you submitted, request for information comes back saying the change of design, include that RFI in there as well. So anything that's associated with that cost, John, needs to go into that packet.
Absolutely.
And you want to put it in chronological order too. Don't just throw it in there. You want it to go step by step by step. So when you're having that conversation with the owners to review it, it's easy for them to understand, because they get frustrated if it's a messy one, out of order, and they're like, I'm going to reject it. So spend the time to put them together. Like I said, you want a summary of the scope change that's got to go in there. Timeline or time impact analysis. That's a tricky one right there, that time impact analysis, John, because it shows here's my baseline schedule. This delay is costing me 45 days. You want to put a time impact analysis together to visually show them that, hey, you are delaying me, and this is why this change is coming. And especially if it's on the critical path, get these time impact analysis in right away. Because if you're pushing that end date out, liquidating damages coming in, and if you don't protect yourself, they're gonna hit you with those liquidated damages because you never submitted time impact analysis. Like we said, RFIs, you include that. Any other supporting documents of cost. PCIs, so that's your internal, where you created this, goes in there. So as you can see, there's quite a bit of things that go in there, but it's a solid, concrete chain order packet. And next, we're gonna go into GC projections, which goes back to, John, that, remember that GCG, general requirements that we put together during bid time.
Right.
So now you're gonna see how that goes into forecasting, which drives back into your stuff.
Exactly.
So with this example, you know, of course, you're gonna put the project name. This is all internal information for yourself. However you wanna do it is great, but this is pretty standard. You know, your project numbers, so that way your internal, your execs know which project it is. And then what I've done is listed all my general conditions that's on this project. You can see there's like 45 lines here. And this is a 7-month project here. So I broke it down monthly. So, you know, we're already 2 months into this project. As you can see, if it's grayed out, that was the actual. Okay, and if it's like October 2020, it's still white, so I'm projecting to use that. So this is a great tool because you can say that, like if you go down to personnel parking here, you know, I budgeted $1,000 a month, which is $7,000. First month in August, I did $1,500. That's an overrun, you can see right away.
Mm-hmm.
The second month in September, I did $1,200 instead of $1,000. So if you go over here, cost to date, I spent $2,700 already out of $7,000. So my projected is going to be $7,700. So I'm losing $700 is a loss on my parking. So you've got 5 months here to start saving, or how you're going to fix that. Sometimes you can't because it's the way it is. But if you have other areas where you can save, so that way your gains and loss, because you want to have a gain on your general conditions at the end. You know, if you can finish the project a week early, 2 weeks early, that's a gain too on your general conditions. So, you know, this here is a great tool, once again, but it has to be done monthly. Know what you're projecting for the month, go back and put in your actuals. And and then you can see bottom line here of, you know, what your gain and loss can be. But I haven't finished the sheet because there's so many items, but it shows you how to set it up, how to work it. And, you know, once again, this is another report you can use with your executives when you sit down monthly. John, I am going to turn this piece back over to you at this point.
Okay, we're going to look at cash flow impacts associated with change orders to try to kind of pull this whole discussion back together to show you the actual impact on your cash flow projection. So you'll remember we started our last discussion of this project for Jack Frost Construction with a $430,000 project. That was our contract amount. We have change orders documented, Robert has set forth, of $150,000. So our revised contract amount is now $580,000. And it happens, just so happens for simplicity, that our change order impacts are really hitting in material purchases for this project. We've basically got more of the same going in to what were the same parameters for the project. So our direct costs are broken down, as he's pointing out right there, associated with the change order, for a revised payout projection in column E there under the direct costs of $490,000, and that ties to the upper quadrant there for our direct job costs, new direct job cost total. We're still at about the same 15.5% gross profit on this project, which is a little thin. All the more reason for us to be managing our cash flow very carefully. Now, we indicated that We had $70,000 of cash to start the project with in week one. We had a $200,000 working capital line of credit. We began with an opening cash position of $170,000 that allowed us to take care of expenditures on long lead items right up front. In order to kind of cut to the chase, we get out to week 7 there, and we've got additional materials to purchase that impact our cash flow. In order to actually make those purchases, we pull down in week 5 another $100,000 of our revolving line of credit in order to have adequate cash to address that cash flow need going into week 7. So as you can see, beginning cash, cash out, cash in, ultimately results in ending cash flow, which if you'll go to the end of our illustration, bottom line, and there we go, and then scroll over to the right. Yes, thank you. Okay. Our revised cost factors are reflective of the change order there in column AI. So our revised cost factors impact the project, thus our net profit is now $48,000. We started with $70,000 of beginning cash, so our ending cash position now is $118,000, and that's essentially what finds its way into our next financial report as accrued earnings impact and cash flow.
So as you can see how important it is, what at project level, what I have been talking about in the last several minutes, goes back into the executives. So now he's taken all those reports, you've sat down as a project manager, sat down with the exec here and went through everything, so that way he can now fill out, you can now, John, can fill out your report.
Exactly.
Will they go to your stakeholders or whoever it is that with the company there?
Okay, so putting it all together here and in a conclusion, we really truly believe that cash management is essential to achieving a successful financial plan overall. A robust approach includes current historic financial results, interim results, updates, and a projection of cash demands. Effective cash management will help you meet your budgetary and strategic market challenges going forward. Anything in the way of concluding remarks there?
No, I think we've hit it all. So, I mean, as you can see how important this is to work together with the entire team, working with the owners, everyone, so that way you can be successful with this, you know. And if you got to hire an accountant to do this, to help you with some of it, do that, put that cost into your general requirements. But like I said, it's a time-consuming, but it's a valuable piece of your business. It's cost and change management.
You know, one of the things that kind of jumps out at me is going back and actually doing another presentation on delay impact and documenting the costs associated with delays. Mm-hmm. It just seems to be an essential part of the discussion.
Yes, it is. You want no surprises. Bottom line is what we're getting at here.
Okay, very good. Well, thank you. Thank you. This concludes our presentation today.